What if I told you the retirement rule millions trusted is no longer enough for 2026?
For decades, one simple formula shaped nearly every retirement plan.
Withdraw 4% every year, and your savings should last. So what exactly replaces the old 4% rule? But today's economy plays by completely different rules.
Inflation, longer lifespans, and market volatility have changed everything.
That's creating a risk many people never see coming.
Inflation, longer lifespans, and market volatility have changed everything. It sounded simple, because for a long time, it worked.
The biggest mistake isn't withdrawing too much. It's assuming every year should be treated the same. Let's break down the new retirement strategy that's changing everything in 2026. Markets don't move in straight lines, and your retirement income shouldn't either. That simple shift dramatically improves the odds of making your money last. Instead of asking, how much can I withdraw forever? The better question is, how much makes sense this year? Today's retirement experts focus on flexibility instead of fixed percentages. Some years, your investments produce more. Other years, they produce less. Think of your retirement portfolio like a business, not a savings account.
Trying to force the same withdrawal every year ignores how markets actually behave.
And once you understand how it works, the old 4% rule starts to feel outdated. That's exactly why financial planners are embracing dynamic withdrawal strategies.
Let's look at a simple example that shows why this new approach works.
During those years, withdrawing slightly more may not hurt your long-term plan. In a strong market year, your investments may grow far more than you spend.
Imagine retiring with $1 million invested in a diversified portfolio.
This approach helps your investments recover instead of draining them at the worst possible time. Financial planners call this adapting to market conditions instead of fighting them. But during difficult markets, reducing withdrawals protects your future. And your retirement plan should work the same way. That's exactly how successful businesses manage uncertainty every day.
It's less about predicting the future and more about responding intelligently. Now, you might be wondering, how much should you actually withdraw each year?
The answer depends on one thing most retirement calculators completely ignore.
Your portfolio doesn't exist in isolation. It reacts to the market every single day. That's why flexibility has become one of the most valuable retirement tools available.
Think about driving a car. You don't keep the same speed on every road.
Flexibility isn't about guessing. It's about making better decisions with better information. And that's exactly what the newest retirement frameworks are designed to do.
You naturally adjust based on traffic, weather, and road conditions.
Retirement works the same way. The environment changes, so your strategy should too.
Guardrails create healthy limits instead of locking you into one fixed withdrawal amount. Ignoring those changes can quietly reduce the life of your retirement savings.
Small decisions repeated consistently often outperform dramatic changes.
Think of it as protecting your future instead of maximizing today's income.
When markets decline, reducing withdrawals gives your portfolio time to recover.
When your investments perform well, you may be able to spend a little more. One of the biggest improvements is something called guardrails.
Successful retirement planning is about sustainability, not perfection. It's a small adjustment today that can make a huge difference years from now.
There's another reason the old 4% rule is losing relevance. That means retirement savings often need to support 30 years or more. People are living much longer than previous generations expected.
And even small improvements in your strategy can have a major impact over that time.
That's why protecting your portfolio during difficult years matters so much.
Every dollar left invested has another opportunity to continue working for you.
That's the power of long-term compounding, combined with smarter withdrawals.
Avoiding unnecessary losses can be just as valuable as earning higher returns. Successful retirement isn't about chasing the highest return every year.
It's about building a strategy that continues working through every type of market. Instead of reacting emotionally, you can follow a clear long-term plan.
Retirement isn't just about how much money you have. It's about how reliably that money produces income.
That's why consistent cash flow has become a top priority for many retirees. Predictable income creates confidence during both strong markets and difficult ones.
Another major shift happening in 2026 is the focus on income sources instead of portfolio size. Markets will always experience uncertainty.
That's often the difference between successful investors and emotional investors. Preparation usually beats prediction.
But uncertainty doesn't have to create fear.
And that's the philosophy behind the retirement strategies leading the way into 2026. Now here's something even more important than choosing the perfect withdrawal rate.
Because no market stays the same forever. The most successful retirees don't rely on a single rule. They build flexible financial habits. Strong retirement plans can adapt without losing sight of the long-term goal.
That's why modern retirement planning focuses on resilience instead of certainty. Every economic cycle creates new opportunities and new challenges. Small adjustments today can prevent much larger problems later. The future belongs to retirement strategies that evolve with the world, instead of resisting it. That's exactly how long-term wealth is protected.
So, what does all of this actually mean for your retirement? It means retirement planning should become an ongoing process instead of a one-time decision. Reviewing your plan once a year can make a meaningful difference over decades. The goal isn't to find a perfect strategy, it's to build a durable one. Small improvements repeated consistently often lead to remarkable long-term results. Durability gives you confidence when markets become unpredictable. Confidence helps investors stay focused during periods of uncertainty. Your retirement portfolio continues progressing smoothly toward future milestones.
And staying invested has historically been one of the most important drivers of long-term growth.
That's why today's retirement strategies emphasize discipline over prediction. Because a disciplined plan can continue working even when the future remains uncertain.
The objective isn't to maximize every dollar today. By now, you've probably noticed a common pattern. Every modern retirement strategy is built around flexibility, not rigid rules. The objective is to protect your financial future for decades. Not because it predicts the future. Yeah. But because it prepares you for whatever the future brings. And that's exactly why the traditional 4% rule is giving way to a smarter retirement strategy for 2026 and beyond. The future of retirement isn't built on one fixed percentage. That's the real lesson behind the new retirement approach. Instead of asking whether 4% is right, ask whether your plan can adapt. It's built on flexibility, discipline, and informed decisions. Markets will always change,